Hi, this is Jim Cunningham. We're going to talk about Prop 19 loopholes, how to keep your low Prop 13 taxes, or how to keep the low Prop 13 taxes on real estate. So for many people, they want to preserve their Prop 13 taxes. So this is really important because property reassessment happens when somebody dies, typically, right? Now, the exception is a spouse or registered domestic partner, or state registered domestic partner, I should say. If you're a county registered domestic partner, you might want to look at becoming a state registered domestic partner, and we cover that in other webinars. But what we're going to talk about here is the doubling or 10xing or 20xing of property taxes a lot of times when people inherit the property. So you may have a piece of property, your parents may have a piece of property. So when that owner of that property dies and it passes to the next generation, it used to be that the property would not get reassessed, but now it is reassessed. And that's thanks to Prop 19. So many families are absolutely blindsided by this. They really have no idea that the taxes are really going to go way up. And we're going to learn there still are a few remaining ways that you can protect your financial future by avoiding certain common mistakes that can lead to a dramatic tax hike. And really, there are some basic things you can do to preserve low property taxes, especially for the family home, and we'll talk about that, and family farm. We're going to go over the importance of timely filing the paperwork with the county. So this is when there's a transfer, a death, or a sale, or a gift. This is when property passes typically from a parent to a child. And hopefully this will save whoever's watching this some property taxes, or people you care about their property taxes. And again, what you don't know can cost you thousands of dollars. If you plan on leaving property to your kids or a loved one, and we'll cover the loved one when it's not a kid, this webinar might just save your heirs from really a 5-figure property tax bill, 5-figure property tax bill, or 6-figure property tax bill, right? Prop 19, again, eliminated the sort of very open parent to child reassessment exclusion. So that means it used to be the parents could leave a large amount of property to children, and the property taxes would stay the same. So when there's a change in ownership, the property is reassessed, and death is a change in ownership. That date of death is a change in ownership. So that's something really sneaks up on people. So let's start with an example. So this is a tax time bomb nobody sees coming. Greg lives for and cares with Granny. I'll say Greg is living with his grandmother, caring for his grandmother. After Granny dies, Greg inherits Grandma's little cozy bungalow, which was mortgage free. Now, I can tell you, for the young people watching this, and if you have young people, or maybe not so young people, buying a home, especially in California, is not easy. Whether it was easy or not in the past, it certainly has not gotten easier today in 2025. So Greg is super excited. He inherits this property without a mortgage, and he expects to enjoy Grandma's low property taxes. In fact, he doesn't really think about it, right? He sees Granny's tax bill of $600 a year, and he goes, wow, this is great. My power bill's way more than that, right? So life is good. And this is until Greg opens up his first post-inheritance tax bill, and the taxes jump from $600 a year to $6,000 a year. So shocked, Greg calls the assessor's office, hoping it's a mistake, but the county confirms this sort of grim reality that, and now this is Greg's new normal, Granny's bungalow has been reassessed. Now, this increases the property's assessed value to its current fair market value, and this could have been avoided with proper planning, and we'll cover this later in our materials. But this is a situation where, even though Greg's not a child, right, even though he's Granny's grandchild, Greg could have avoided reassessment, and we'll see how that works. So if you're watching this on YouTube, please subscribe to our YouTube channel. We post videos pretty much once a week, Thursdays at 6 p.m. And if you click the bell, you'll be alerted to when our content drops. So very high value content. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney over 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities insurance licensed, and a pilot single engine land instrument rated, although I'm not current. I'm also a 3rd-generation pilot and a 2nd-generation lawyer. Disclaimer, this is not legal advice. This is information only, okay? This is very, very important. When I say you, there's no attorney-client relationship. I'm not, you're not a client. When I say you, it's very, very important. This is information only. Hopefully it's mildly entertaining, because this can be kind of dry. So what is reassessment? And we're going to look at a few examples from Zillow. We're going to look at why is this such a bad thing? Well, what we've got here is we took some screenshots from Zillow, and if you're like me, I'm kind of a real estate junkie. I like to go on Zillow and Realtor and Redfin, and I'm always looking at property. And a lot of times it'll show you what the property tax history was. And if you notice, some of these have really steep increases. So to me, as a lawyer, I look at that and I say, gee, the property was reassessed. So that means probably it was sold to somebody or given to somebody without a reassessment exclusion. Okay. So this sort of parent to child exclusion under Prop 19 or some other interspousal reassessment exclusion. So this example here, we've got the property taxes used to be $624. Now they're $10,500. The assessed value was $35,000. Now it's $850. So that's one example. That's a huge increase. That's almost a 1,600% increase. These are real examples. This is a home in San Rafael. The property taxes were $4,500 a year, and they go up to $10,500 a year. The assessed value going from $200,000 to $700,000. So again, real examples. And here's another one from Sacramento. You've got the property in 2018. The assessed value was $102,000, and then the assessed value jumped to $433,000. So the taxes went from $1,300 to $5,100. So this is what we're talking about. We're talking about the property taxes going up. And if you're a normal person who wants to pay the least taxes lawfully possible, which I think we can all agree is most people, then you're going to be paying more taxes when that property gets reassessed. So let's go back and briefly look at the sort of history of property tax in California, because it's important to understand what the property tax system is before we can figure out ways to preserve our low property tax assessment. So it's very important. Again, we cover this in other webinars on our YouTube page. And if you haven't visited our YouTube page, I would encourage you to take a look at it. Now with AI, you can actually ask our YouTube page questions, which is kind of cool. So how do property taxes work? Well, property is based on its assessed value. So what happens is the elected county assessor is in charge of the group of people. Sometimes it's one person in a small county, right? And that county assessor is charged with figuring out what stuff is worth. So what is the value of this property? And these property taxes are typically billed annually or semi-annually, and they're payable to the county tax collector. So the assessor says, hey, tax collector, this property's worth $1 million, and go ahead and run your calculation and go ahead and send the bill out. So under Prop 13, property is taxed at 1% of its assessed value. So whatever that assessed value is, right, when that change in ownership occurs, it's going to be 1%. Now, if some of you say, well, Jim, my taxes are more than 1%, the localities with a 2/3 vote can pass parcel taxes, which are typically kind of flat fee taxes, or additional ad valorem, or based on the value, or ad valorem meaning deriving from the value in Latin. So from the value, your property taxes can be higher, but the state, the base property tax is 1% unless a locality adds to that. So that's why it might be higher. And this only can go up 2% a year. So over the last 40 or 50 years, California real estate has increased on average about 6%, but the property taxes go up 2%. And if you hold a property for 10, 20, 30, or 40 years, maybe now coming up on 50 years, then that delta can be really big. And that's why I say that keeping your Prop 13 taxes or having a Prop 13 assessment, having a low assessment, is a valuable property right that you don't want to let go. You want to preserve that. So changes in ownership require the county assessor to reassess the property at its current fair market value. Death is a change in ownership. Obviously, a sale is a change in ownership, but dead people don't own stuff. Like, this is just kind of basic reality. If you're dead, you don't own anything. Your estate does. And as far as the county assessor is concerned, when you die, when you leave this earth, the property, that is a change in ownership. So whoever ends up with that property is the new owner, but that happens at death. It doesn't happen when the trust is dissolved. It doesn't happen when the probate's over, at least under current law. It just gets reassessed. And so you have this much higher tax bill. So Jane purchases a home in Los Angeles County. In LA for $500,000. Under Prop 13, the assessed value is set at the purchase price of $500,000. The property tax rate in her area of Prop 13 is 1% plus local taxes of 0.25%. So Jane's initial property tax bill is calculated $500,000 times 1.25% gets you $6,250 a year. Each year thereafter, that assessed value increases by 2%, and therefore the 1.2% property tax increases. So in the year of the purchase, the property taxes are 6,250, but the following year they go up a little bit to 6,375. So that's why when you get your tax bill, when your taxes keep going up a little bit every year, that is what is going on. So it's not a flat, it's not a fixed dollar amount. It does go up at 2% a year. So let's say Jane purchases a home in LA. Let's roll back. Instead of buying it for 500,000, let's say she bought it in 1985 for 120,000. Jane keeps the property for 40 years, 40 years before passing away in 2025. Remember, death is a change in ownership. She leaves this home to Kevin, her son. The fair market value is 1.2 million, but the assessed value is 263,000. This represents 120,000 plus 2% a year. That's how we get to the assessed value of 263,000. The property taxes are 3,300 a year. If it's reassessed, so it's reassessed when it passes to Kevin, the new assessed value is 1.2 million. So the property taxes jump to 15,000 a year. So while Jane's alive, they're 3,300. But when Jane passes away, Kevin is now the owner. Now, this is whether the trust administration is complete or the probate is complete. It doesn't matter. In fact, Jane could have had no will, and maybe it passes to Kevin by intestacy. So that means if you don't have a will, and if Kevin's her only child and Jane's not married, it's going to go to Kevin. So those taxes go up the day Jane dies. Now, Kevin may not know this. He may sell the property and spend the money and get a supplemental unsecured bill, right? 11 months after he tells the assessor that his mom has passed away. But this new property tax bill goes up. Now, sometimes Prop 19, if Kevin essentially moves into the house within a year and files a form within 3 years, although he should file it within that year, if Kevin moves into the property and makes it his home, then he can keep those low property taxes. Okay, so this is the family home exemption. So Kevin can keep that home, and based on these numbers, the property would not be reassessed. So you basically have a freebie of $1 million. So if Kevin could inherit a home of up to $1,263,882 and not be reassessed. There is a little inflation adjustment in there, but understand for this example, the property's reassessed unless Kevin takes some steps and Kevin otherwise qualifies. So what will your property taxes be? There's a California property tax calculator. We put that in the notes this is on smartasset.com, and they'll kind of calculate your property taxes. So that's a little bit helpful just for planning purposes. There is a property tax postponement for those of you who are low income or know someone who's low income. Homeowners who are seniors, blind, or disabled can defer current year property taxes on the principal residence if certain criteria are met. Now, this is not a reassessment avoidance. This is a way to defer your property taxes. You have to be 62, blind or disabled. You have to have annual household income of $53,574 or less. Now, it is not uncommon for a retired person to not have much income. You might be living on Social Security and inherit a rental property. Maybe it's a property your parents weren't living in, but you're 65 and you inherit this property from your parents and you're living in it and you don't earn much money. It's going to get reassessed, right? If it's not your parents' home, if it was like they own it and you're living in it and your parents aren't living in it, it does not qualify for the Prop 19 parent to child reassessment exclusion. So it's got to be your principal place of residence. You have to have at least 40% equity or 40% ownership interest in the home, not have a reverse mortgage on the property. It's another kicker. And this deferment of taxes is secured by a lien against the property that will be repaid. And for 25 and 26, the applications are available in September 2025. And the filing period opens in October and closes in February 10, 2026. So we're doing this webinar in May of 2025. That time period, that February of 2025 has already passed. So if this is you, or this is somebody you know, or if you're a realtor, or you're a CPA, or you're a lawyer, and you know someone who's really struggling to pay, look at the example here. What if those property taxes go from $3,000 to $15,000? If somebody's making $2,000 a month on Social Security, they can't afford to live in that property. And most people don't want to move from their home. So this is a way, if you're low income, of deferring those taxes. So this is a great program. It's through the state controller's office. There's a limited pool of money. So it's first come, first serve, but definitely check this out. And we'll put a link in the notes for when we post this on YouTube. Well, let's look at a brief understanding of Proposition 13 and 19. So Prop 13, the old rule everybody loves, which is tax your property at 1%. The taxes only go up 2%. This was passed in 1978, was a taxpayers' revolt. At the time, property was taxed significantly higher than 1%, and it kind of went up as the real estate went up. So people were literally getting priced out of their home because the taxes went up so much. And for those of you who were alive in the 1970s, you know, it was a time of economic stagnation, high interest rates, and sort of really flat or no growth. And it was a very difficult time. People had a hard time getting enough money together to buy food, right? So these annual increases in the assessed value, again, they're capped at 2% regardless of the property's market value, so that property could go up 10x, 10 times higher, and your property taxes are going to be, the increase will be capped at 2% a year. This provides stability, predictability for property owners by preventing sudden spikes in property taxes. So if everything doubles around you, your property taxes aren't doubling or tripling, right? If the county ran out of money, they could just raise taxes. Well, that ended with Prop 13. So again, property's fully reassessed only when there's a change in ownership. And a change in ownership is by death, gift, sale, or certain LLC transactions if things are happening inside of an LLC, and we'll talk about that. So Prop 19 was passed in 2020. So Prop 13 gave us low property taxes. Prop 19 let us take our property taxes to a new property. It also killed, broadly speaking, the parent-to-child reassessment exclusion and limited it to the family home and limited the reassessment exclusion to a dollar amount. So stated another way, it used to be that you could leave property from parents to children, and many times that none of that property was reassessed. Okay, just given most situations. And the home of unlimited value could go to a child. Unlimited value could go to a child, and that property would not be reassessed. Well, now you can only, you get a little over $1 million. It's $1,022,000. They have not yet released the new numbers for 2025. It is going to go up a little bit, but now you only have a reassessment exclusion of $1,022,000, and we have an example to walk through what that means. So that's the $1 million cap. So transfers to children and grandchildren, again, lost the reassessment protections under Prop 13. The grandparent to grandchild exclusion, by the way, only applies if both of the grandchildren's parents are deceased. So it's a very limited exception, and we really don't see that too often. There are still some existing exemptions. So the family home exemption, we'll discuss more about that. The family farm exemption. So if you own farmland, that is a per parcel exemption. It's not all of your farmland. So that can be a very powerful tool to avoid reassessment for people who own farmland. And there also are a few other strategies. These are not exemptions. These are strategies to avoid reassessment, and we'll cover a few of those. Again, reassessment is triggered when there is a change in ownership. You have to meet a three-pronged test. We cover this in other webinars, but death is a change in ownership. Obviously, if you sell a property, it's a change in ownership. If you give a property, if you give part of a property, it's a change in ownership. So what is a change in ownership? Revenue and Taxation Code Section 60 defines a change in ownership as a transfer of a present interest in real property, including the beneficial use thereof, which is the income, the value which is substantially equal to the fee interest, meaning the value of what, like if you give somebody, I'll give you the right to receive this income for 50 years, you're basically giving the person the property. It's going to get reassessed. So the Pacific Southwest Realty and the Steinhardt case, those are the two seminal cases in this area for those lawyers and maybe other legal professionals out there. For the lawyers out there, if a grantor conveys a property to an irrevocable trust and that grantor retains a limited power of appointment, that is an incomplete gift under the Internal Revenue Code. That means the property is not reassessed. So this might be a useful tool if you want to make a gift of property to children, but it's going to get reassessed at death. But effectively you've given it to them, but this retained limited power of appointment is not a completed gift. So we don't see that too often, but that might be that might be a planning strategy for the lawyers out there. So what are some examples of changes in ownership? Owen sells Greenacre to Abel for $1 million. A sale, change in ownership. Owen leases Greenacre to Abel for a term of 20 years with 3 5-year options. That's a change in ownership. So you take your lease plus your options, you add them up together. If that's over 35 years, or if it's 35 years or more, the property's reassessed. Mom gives the family home to the daughter or sells it to the daughter for $1, that's a change in ownership. So you can't say, oh, well, I'll just sell it to you for $100 and magically the assessed value will be $100 and the taxes will be $1 a year. No, it doesn't work that way. Prop 19 loopholes. This is what you've been waiting for, transferring your tax base. So big loophole. I mean, it's not a loophole. Really, it's what Prop 19 is about in the first place. So this is if you have a home and you want to sell this home and you want to move to a different place. This allows you to sell your home, move to a new home, and take your Prop 13 taxes with you. So you sell your place for $1 million, you buy another place for $1 million, your taxes are not going to change. So if the property has a higher value, they're changing on the difference of the higher value. If you sell your residence and buy a replacement residence, even a more expensive one, the difference in market value is subject to more tax. But it used to be that you would just get reassessed on the whole thing. So if you sell that $1 million home and buy a $1.1 million home, your taxes are going up about $1,000 a year. This applies to people who are 55 or over, severely disabled, and victims of wildfires or other natural disasters, which unfortunately we see here with increasing frequency in California. This must be a sale. This is very important. It must be a sale, and you must file your BOE 19B, as in Bravo, within 2 years. So it has to be a sale. So you can't give your home to your kids and then transfer your tax base. In fact, when you transfer that property, you must transfer 100% of the property. So you can't transfer half. You got to transfer 100% of the property, and it must be fully reassessed when it is transferred. So there's no change in taxes if it's equal or lesser value. It's 100% if the replacement value is properties acquired prior to sale. They give you a little bit more, I guess, factoring inflation. It's 105% if you're acquired in the first year after the sale. So you sell your home in Southern California and you move to Northern California. Well, if you buy your Northern California property first and then sell your Southern California property, it's 100%. You can buy a home of equal value. If you sell your Southern California home first, then buy your Northern California home, and it was $1 million, you could buy a Northern California home for $1,050,000 in that first year, or between years 1 and 2 for $1.1 million, and your taxes wouldn't go up. And if this is all very confusing with the numbers, just understand you can move your tax base, but there are some details in here. The amount over the equal or lesser value is added to the property tax value. So what that means is if you sell a property for $1 million and you buy a replacement property for $2 million, your taxes are going up $10,000 a year because the difference is $1 million. And that's at 1%. These have to occur within 2 years of each other, and there's no requirement for these to happen in a certain order. You could buy your replacement property and in 1 year and 11 months relinquish your existing home, but you're going to have to file that paperwork in a shorter period of time. So co-ownership. Can I have a co-owner on title and still qualify to transfer my base year value under Prop 19? Yes. There's no requirement that the homeowner who is over 55 or severely disabled or a victim of a wildfire be the sole owner of either the original primary residence or the replacement primary residence, but that property has to be 100% reassessed. So if you own the property 50-50 with your kid, and then you sell it to your kid, that property is not going to get fully reassessed. You and your kid would have to sell that property typically to a third party, and then you move your property tax base. So mom sells her Monterey home for $4.5 million with an assessed value of $500,000. Mom buys a replacement property in La Quinta for $4.5 million. Mom goes on title as to 10%. Daughter goes on to title as to 90%. Mom dies. Is the property reassessed? And if so, by how much? There is no clear answer. Okay. So this is where mom owns the property and then she adds daughter to title. Some counties are taking the position that only mom's portion would get relief. So the 90% that daughter purchased would not, would be, 90% of 4.5 million. So it's going to, taxes are going to be 40,000 a year. San Diego County is taking this position we've seen in the last couple of months, meaning mom sells her home, buys a replacement home, puts a child on title. Only mom's portion gets the reassessment exclusion, not the daughter. There's no clarity on this. And if you work at the assessor's office, more power to you. I don't know how you're even going through this stuff, frankly, because there's just an absence of guidance. It's a little chaotic, to put it mildly. Prop 19 loopholes, parent to child transfers. Okay, when a parent transfers, their main home to their child, their primary residence. The first $1,022,600 of the home's assessed value isn't reassessed. If the home's market value is higher than its old assessed value, plus $1,022,600, and if you're watching this on YouTube, ignore that word million. The extra amount is reassessed at today's market value. And we have an example here. It's only for primary residences and requires the child to live in the home as their main residence or as their primary residence after the transfer. To use this, you got to move in though within a year, and you do have to file the form within 3 years, but they're going to reassess you. Like if you move in a year, I don't wait 2 years, right, to file that form. You should file that right away to let them know, because otherwise they're going to reassess you. And what they'll do is they'll say, oh, well, it's going to take us a while to give you tax relief. So just go ahead and pay the higher taxes and we'll give you a refund later on. Well, I don't like that, right? So that's why you want to file your information timely. So here's what happens is child moves into the home within 1 year of change in ownership. So parent dies or parent sells the property or gives the property to the child. Child has to be living in the home within a year. And the attorney or client files the BOE 19P, which is parent to child reassessment exclusion, or the BOE 266. So in this case, we'd be filing the BOE 19P. So that's a form. So you can go and look up that form. You can fill it out. It's pretty straightforward. If you need some help, you can certainly reach out to us. So parent to child transfer rules. If the transfer occurred before February 15, 2021, daughter would file a claim for reassessment exclusion between parent and child. Now, you may say, Jim, this is 2025. This is 4 years ago. But you know what happens? A lot of times, mom died maybe in 2019, and the daughter hasn't gotten around to doing anything, right? Daughter files a claim for reassessment exclusion. There's no reassessment of mom's residence, no requirement for the daughter to live in the home. Late filing is okay, but you pay the higher taxes in the interim. So if you've been sitting on your hands for 5 years, you're going to pay those higher taxes for that 5-year period. If the date of death is February 16 to February 15 of 2023, mom is eligible for the homeowner's exemption, meaning it's her home, the daughter must be eligible for the homeowner's exemption within 1 year of the change in ownership and file the documentation within 3 years. So there's one of the problems with this, by the way, and if you're listening to this going, this sounds really confusing, I'm doing my best to keep it together and not be confused. And I'm one of the people I think that understands this the best out of my colleagues in the legal profession. There's one really weird thing that's missing. When does the daughter have to be on title? There's nothing in the rules or the law that says when the daughter has to go on title. So if you're asking me, hey, when does the daughter have to be on title? Nobody knows, because there's no statement of when she has to be on title. But the daughter, when she inherits, let's say she inherits it through a trust or a will, they're going to kind of essentially ignore the trust and ignore the will and all the process around it. And the assessor is going to want to know the day that mom died, who was entitled to that property. Okay. Now, if there are siblings involved and the daughter wants to buy out other siblings, that has to happen in the trust administration or the probate. It cannot happen after the property's been distributed to the daughter and siblings, because then you're going to get reassessed, because then the daughter's buying out the siblings. There is a workaround on how to buy out a sibling in a trust administration. We cover that. We have a whole webinar devoted to that, and it's a little archaic and cryptic, but it can be done. Typically, you're going to need some outside money, but we cover that in detail. Again, you have to complete and file your form BOE 19P as in Papa or P as in parent. The $1 million exemption, there's $1 million exemption for deaths from 21 to 23, and then $1,022,600 is the reassessment exclusion, or the coupon amount. That's the amount of difference between assessed value and market value. If the difference between the assessed value and the market value is greater than $1,022,600, then to the extent it's greater, it's reassessed. That's through February 15, 2025. We do not yet have the current numbers for 2025, but that is scheduled to be adjusted for inflation. So stay tuned on that one. The Prop 19 exemption amounts, let me just go through a couple more examples, just so to try and help this be a little less clear than mud, right? Or a little more clear than mud. If your assessed value is $900,000 and you inherit your parents' house, there's not going to be a reassessment, because the house itself that you're inheriting is valued at less than the parent to child reassessment exclusion of $1,022,600. So if that house is assessed at $800,000 or if it's assessed at $100,000, your property taxes are going to stay the same, provided you do your forms, provided you submit those forms to the county assessor. If the assessed value is $600,000 and the date of death value is $1.5 million, there's no reassessment, because when we look at the difference between $600,000 and $1.5 million, it does not exceed $1,022,600. But if your assessed value is $200,000 and the date of death value is $1.5 million, there's a reassessment of $278,000, slightly less than $278,000, and that difference is added to the tax bill. So your property taxes are going to go up about $2,800 a year plus, so a couple $100 a month. I hope those examples help to understand this. Part of this is understanding what's going on, because the child who wants to stay in the parent's home has to make some decisions pretty quick. Not only have you lost typically this is the second, could be first parent, could be second parent. Typically, if you lost a parent, which is a big deal for everyone, I would think, you also have to make a lot of decisions within that 1 year period. Do you want to move into your parents' house? Now, if you happen to already be living there, it's easy, right? Do you want to stay there or not? It's a little different than, do you want to move into your parents' house? And for many people, they don't. And so then there's no parent-to-child reassessment exclusion, and the property is going to get reassessed as the date of death. So when do you file your 19 BOE, not BOA, BOE 19P or BOE 19AH? This is pre February 16, 2021. You have to file, you have to pay a fee for the homeowners or disabled veterans exemption with the year of the date of death or change in ownership. If it's filed after the 1 year period, prospective relief may be available. So if you file it after a year, but before those 3 years, then you're going to pay the higher taxes for that time. So that's what I was saying. When a parent passes away, you're better off having filed this thing within the first year, because then you're not going to be paying higher taxes. It is timely filed if it's filed within 3 years after the date of purchase or transfer or death, whichever is earlier. But if it's filed in years 2, I guess it would be in years 2 and 3, the problem with that is you're going to have to pay that higher tax that in that from date of death to the date that you file. So you've got some time limitations in there. So here's a question. How many times can you do this? This is question 10 from the letter to assessor 21008. By the way, the Board of Equalization promulgates its rules in letters to assessors and the property tax rules. So this is from, you can just Google LTA 21008 and this is the PDF will pop right up. How many times can you do this? How many parent to child transfers can you make? As many times as you want. There's no limit. So a parent sells a family home to his oldest child, purchases a smaller home, which becomes parent's family home. After a few years, this home is too large and parent sells a smaller home to parent's middle child. Subsequently, parent buys a condominium, which becomes parent's new family home. As long as both children meet all qualifications, both transfers qualify for the intergenerational transfer exclusion. What about the homes you already own? What if mom and dad own 5 homes and they have 5 kids and they move from one home and then one renter moves and then they move into that other rental home and they're there for a couple of years and then they give that property to the child. Maybe you can daisy chain this together. I don't know. I don't know what the answer is to that. Prop 19 loopholes, co-tenancy exclusion. Pay close attention to this. This to me is probably the single most valuable Prop 19 loophole. The co-tenancy exclusion is added to California's Revenue and Taxation Code back in 2013, effective January 1, 2013. And this prevents reassessment on the death of one co-tenant if 2 people are on title and they own 100% of the property together continuously for 1 year before the death. So there are 2 people on title, A and B. They need to be on title for 1 year before either A or B dies. The property must have been their principal residence for that year, which means homeowner's exemption, right? Means you have to live there. You're not renting the property out. Probably your driver's license is there. Your voter registration's there. Maybe, your power bill goes to that address and you claim the homeowner's exemption. And the transfer must be solely due to death. So this was originally designed for long-term joint ownership situations. These were often unmarried partners. This 2013 predated marriage equality, and that has changed. That the legal ability for people to marry has changed. Arguably, the rationale for this exclusion has gone away, but it hasn't gone away and it's still law. And so there's a special affidavit that typically the attorneys file after the death of one co-tenant to avoid reassessment. So let's not talk about partners, right? Let's talk about a nephew moving in to the home to take care of the aunt. I mean, that happens, right? So auntie adds nephew as a joint tenant. Now, setting it, I'm not saying this is a good idea. In fact, this may be a bad idea for capital gains tax purposes, but adding someone as a joint tenant means there's going to be no reassessment. Auntie, in the alternative, adds nephew as a tenant in common for 1%, resulting in 1% reassessment. So understand that if auntie adds nephew as a joint tenant, that is a gift. Okay. So auntie's going to probably need to file a gift tax return. Maybe no gift taxes due, but at 1%, this would be a $20,000 gift, and a gift tax return likely would be due. It just depends on what the current gift tax exemption is. The assessed value is $200,000, meaning the property taxes are $2,000 a year. The market value is $2 million. If this property were reassessed, the taxes would jump from $2,000 to $20,000 a year. Now, I don't know about you, but $18,000 is a lot of money to anyone. Okay. In fact, it may be the difference where nephew could not live in the property if he had to pay those $18,000 a year property taxes. Auntie dies and nephew inherits the home. No reassessment. This saves $18,000 a year in taxes. I would say this requires artful estate planning. Now, can you do this with a child? Great question. We have an example in the next slide. So if you have two co-tenants, a surviving co-tenant, what happens after death? Death must sign an affidavit under penalty of perjury affirming that they've continuously resided at the residence for the 1-year period immediately preceding the transfer or co-tenant's death. So nephew needs to file an affidavit saying, I lived there for 1 year before auntie's death. And if it's not available, if another exemption is available, such as parent to child, then you can use that. Or they might use both, and we'll talk about that in the next slide. The LA County Assessor confirmed in an email. By the way, this is where we get our authority. The LA County Assessor emailed somebody, right? And they said the child can pick between the better of the parent-to-child reassessment exclusion or the co-tenancy. I'm not buying it. I would not rely on an email. I don't know if they've changed their position. If you work for the LA County Assessor or you've been involved with them on this issue, please let us know, because we're going off of emails and whispers and shadows. This is kind of the status of property tax reassessment in California, which is kind of scary. But what about the kids? So this is a real case that we handled. Dad owns home with an assessed value of $500,000 and a fair market value of $5 million. When dad dies, the property taxes are going to go up $45,000. Son has been living with dad for years. Son is in fact taking care of dad, which is not uncommon that a child cares for a parent, right? So dad adds son as a 1% co-tenant. Dad owns 99%. Son resides at home with dad. Dad and son are on title for at least a year. Then dad passes away. Dad dies and son gets $1 million reassessment exclusion on the first million, and meaning son picked up the parent to child reassessment exclusion. At the time it was $1 million. So dad dies, son inherits the 99%. So the San Francisco assessor said, you're going to use the parent to child family home exemption on the first $1 million reassessment exclusion, but the balance of the potentially $3.5 million reassessment, you're going to use we use the co-tenancy exclusion. So the son avoided reassessment and we saved the family $45,000 a year. And this family does not have $45,000. I mean, a $5 million home sounds nice, but if you don't have any other money, paying a $45,000 a year tax bill is not going to happen. This is a real case. This requires artful estate planning, and I cannot emphasize enough the artful portion of this. This is not for novices. This is not for inexperienced lawyers. This is not for newer lawyers. This is not no DIY project. This is very complex tax estate planning situations that require a really broad understanding of all of the issues that can potentially come up, as well as a path forward to avoid reassessment. So let's talk about the family farm reassessment exclusion. So a change in ownership does not include the purchase or transfer of a family farm between parents and their children. The family farm is any property that's under cultivation or being used for pasture or grazing or to produce any agricultural commodity. So take a drive in anywhere in rural California. It's either used for farming or ranching or logging. Pretty much that's all the land. I mean, there's very little land in California that's essentially left fallow. Agricultural commodity is any and all plant and animal products produced in California for commercial purposes. So if you graze cattle on some hilly property that has no water, that's still ag property. If you have planting row crops in Southern California, and that's farm property as well. So it's going to cover the spectrum. This applies separately. This is very important. This applies separately to the transfer of each legal parcel that makes up the family farm. So it's not just the family farm. This is each parcel. Now, I will tell you one of the issues is the title has to be in the parent's name. If the title is in an LLC or potentially a corporation, and we do get that quite frequently, these rules may not apply. So it's very important. We need to really pay attention to the titling of the properties. Each legal parcel that makes up the family farm is deemed to be itself a family farm, except for a legal parcel containing a family home. So I think a lot of people tend to think a family farm would be a family home on a piece of land that's producing agricultural commodities. But in my mind, a family farm is typically going to be a piece of land without any improvements beyond maybe a greenhouse or some other type of improvements. It's a legal parcel that is part of a family farm. So if the legal parcel contains a family home, not a home for employees, not a commercial structure, maybe a warehouse, but if it is a if it is a parcel that contains the family home, it's under a different exclusion. Okay, it's under the family home exclusion. So let's look at an example, and this has to do with how many parcels you own. Mom and dad own a family farm of 8 parcels of 40 acres each, so 320 acres. Each parcel is worth 1.1 million, so the total is 8.8 million. Each parcel is assessed at 100,000, 8,000 per year property tax bill total. The parent to child reassessment exclusion is $1,022,000. The 8 parcels transferred to the kids with no reassessment. So the parcel has a family home valued at $900,000 in our case here. So there's no reassessment. The parents are actually living there. So understand that if you have multiple parcels, you're going to go on a per parcel exemption. Well, what if mom and dad have a single parcel of 320 acres? The parcel is assessed at $800,000 and the parents pay $8,000 a year in taxes. The 320 acre parcel is worth $8.8 million, same value. The exemption is $1,022,000. The parcel is reassessed at transfer. The assessment jumps to $7.77 million. The taxes go up to $70,000 a year from 8. That's big. So if you own farmland, you need to pay attention to this, right? Very, very important because we go on a per parcel reassessment exclusion. Let's talk about using LLCs as part of the Prop 19 loophole. So I would say broadly speaking, if you're going to buy investment real estate, and I'm not talking about a personal use asset like a home or a second home, a residence or a second home, consider purchasing the real estate by an entity like an LLC or potentially a partnership. You're typically going to be an LLC, oftentimes taxed as a partnership or a disregarded entity. And those are 2 ways that the LLC is taxed, but it's still an LLC. Many times when the owner of an LLC dies, the reassessment can be avoided if the property is originally purchased by the LLC or reassessed when the property went into the LLC, and sometimes with some strategic planning that we're going to talk about here. So this is why people use LLCs to buy real estate, is you may never have that property reassessed again, ever. So for example, Intel's plot of land in the heart of Silicon Valley has a current value of about $2.50 a square foot. Across the street, it's $126 a square foot, right? So they're paying tax 1% of $250 a square foot instead of 1% of $126 a square foot. Disneyland paid 5 cents a square foot for 500 acres. If that land were reassessed to its 2025 values, Disneyland could pay around $9.8 million more per year in tax to Orange County. And that's a big delta, right? Their assessed value is, they paid $1 million in property taxes in 2004. It probably should be 11 million, okay, if it were reassessed. So when big corporations buy property, the property's generally never taxed. That includes Chevron, includes all the big property owners in the state of California. It's just not reassessed because it's owned by an entity. And if no one person owns 50%, more than 50% of an LLC or a control of the LLC does not change hands or control the entity, the property is never reassessed. This is the big case, Ocean Avenue LLC versus County of Los Angeles. And if you are looking into this planning, whether you're a lawyer, CPA, even if you're a more sophisticated client, I would really recommend you look into this. You Google it. You can use AI to give you a summary. But Ocean Avenue LLC was an original owner of the Fairmont Miramar Hotel in Santa Monica, right across the street from the ocean. And when it came time to sell, the members of the LLC did it strategically to avoid reassessment. Instead of selling the property itself, the LLC owners sold the shares of the LLC to buyers where no single buyer acquired 50% in the LLC that owned the hotel. Under California property tax law, a change in ownership that triggers reassessment generally occurs when a single entity or individual obtains a majority stake over 50% or obtains control. And this was Michael Dell was part of this. He and his spouse and his children bought it. The LA County assessor sued and lost big time. So the LA County assessor had to pay Michael Dell his legal fees. That's how badly they lost. So there was no Prop 13 change in ownership because the property was held by an LLC when all of its membership interests are sold, but no buyer gets more than 50% or nobody gets control, then there's no reassessment. Does this get around the mansion tax in LA? Arguably, I don't know. We haven't done this, right? Measure U. A lot of people lost their mind when the mansion tax, and that's the extra tax on properties over $5 million. Does this get around the mansion tax? It might. It's not a change in ownership. And I think that mansion tax only applies when there's a change in ownership. That's just my opinion. Don't go to the bank on that. Just something interesting to look at. So let's look at this other LLC example. Baker creates Elm Street LLC. Elm Street LLC then buys 789 Elm Street. 20 years later, Baker sells the shares of Elm Street to Charlie Delta and Echo, each of whom own a 1/3 interest in Maple LLC. There is no change in ownership and no reassessment when these shares change hands. This is essentially what happened in the numbers are a little bit different. Ocean Avenue is a very complex, very factually complex. This is significantly simpler when it comes to its facts. But in this case, the assessor can't reassess the property. There's no documentary transfer tax because there's no change in ownership. In fact, if you try and pay the documentary transfer tax, the tax collector and the assessor won't take it. 49% is better than 0%. When people sell, give, or die real property, there's a change in ownership. Transfers between spouses and registered domestic partners, and I would stress state registered domestic partner. And if you're a registered domestic partner in a county or municipality, you probably want to perfect that or think about it. And again, this is not legal advice. You may want to reconsider filing as a state registered domestic partner. These are not changes in owners. Lifetime joint tenancy transfer is not a change in owner if one original joint tenant's on title. So if I own a property with somebody else's joint tenants and the two of us convey it to me, that other person, and some new person, all third, that's not a change in ownership. When somebody dies, there's a reassessment, right, of that third. But there's no, when the original owner dies, the full property is reassessed. But the point is, when you quote add a joint tenant, there's no reassessment. So long as no more than 50% of an LLC is sold, given away, or the owner of the LLC interest dies, there's no change in ownership. And there's no change in control. There's no change in ownership. The property is not reassessed. So up to 50% can be transferred, no change in ownership. You transfer 51%, the whole property is reassessed. Not 51%, the whole property is reassessed. Again, does this get around the mansion tax? So here's an example. Mom has a beach house, rental assessed at $500,000 and worth $3.5 million. Mom gives 51% to son, and this 51% is reassessed. So the taxes go up from $5,000 to $20,000 a year. Son puts his 51% into an LLC, and mom puts her 49% into the LLC. When mom sells, gifts, or dies, there's no reassessment on that remaining 49% because not more than 50% of the LLC's changed hands because son already had 51. So mom's transferring 49. So this helps with reducing the reassessment, right? It's essentially getting a 50% discount on the increase in your taxes. So this saves son $15,000 a year. But there are some better vehicles. Now, I really want you to pay close attention to this one because I'm going to give you this example, and then I'm going to go through how the assessor would blow through this transaction, apply the step transaction doctrine, and kind of defeat the whole purpose of the planning or not. So just pay attention closely. And I'm going to use an example of a husband and wife. Now, not all couples are husbands and wives. Sometimes you have husbands and sometimes you have wives that are couples. But I'm making this very simple so that you can understand a concept. So what we have is we have a husband and a wife who have a son and a daughter. This is very complex. I'm trying to describe this in a way where it's easier to understand because it's hard to understand. Okay, I'm making something that's very difficult to understand, bringing it down to a more learnable. So husband and wife have children, son and daughter. Husband and wife transfer a rental property to Marin LLC. At husband's death, husband's half of the LLC goes to son and daughter. So husband and wife own this property and they put this real estate into Marin LLC. And in exchange, husband gets 50%, wife gets 50%. Those are the two members of that LLC. That is a proportional interest transfer. That is not a change in ownership. If husband and wife and son and daughter were on the LLC and husband and wife transferred the rental to Marin LLC, the entire property would get reassessed because you have son and daughter on there as co-owners. So husband and wife convey the rental property to Marin LLC, and in return, husband and wife get 50-50 ownership in the LLC, right? Husband dies. Husband's half, under his will or his trust or whatever, goes to son and daughter. So son gets 25%, daughter gets 25%. Wife or mom has the other 50%. Wife, son, and daughter thereafter remove the rental from Marin LLC. That's the name of the LLC, Marin LLC, and take title as wife 50%, or widow at this point, 50%, son 25%, and daughter 25%. So there's a deed that goes from Marin LLC to W, wife or widow, 50%, son 25%, daughter 25%. They take that in their own names as tenants in common. And we cover that's not as joint tenants because it'd have to be a third, a third, a third. You get reassessed. It's not a proportional transfer. In California, that would be tenants in common. Thereafter, the mom or the widow and the son and the daughter create Raman LLC, which is an anagram of Marin. And the reason I did an anagram is it's a jumbling of the words. It's a different LLC. Okay. So this is just to teach you the concept, just to flag it that it's a different LLC. So mom, son, and daughter create a new LLC. They transfer that property to Raman LLC, and that holds the property. And in exchange, mom gets 50% of the LLC shares, son gets 25%, and daughter gets 25%. That is a proportional interest transfer. So that means when mom puts her 50% in and son and daughter put their 25% shares in, and then they get in return, mom gets 50% and son and daughter get 25% each. That's a proportional interest transfer. That is not a change in ownership. Mom dies, right? And son and daughter inherit mom's 50%. So son inherits 25%, daughter inherits 25%. They add that to the 25% they have. So they each have 50%. Now, that, if you've been watching and paying attention, that should avoid reassessment, right? It should. But, well, then we have a graphic here. So house goes into Marin LLC. Husband and wife have 50-50. Husband dies. Husband leaves his half to the two kids. Wife gets half. Wife keeps her half. Then the property comes out of the LLC to mom 50%, the two kids 25-25. Then the three of them put that property into the new LLC, and then son and daughter inherit mom's 50%, 25% each. So son and daughter end up with 50%. Now, this should, because nobody has received because not more than 50% of the LLC is transferred, and control hasn't changed. Under our example here, control hasn't changed. And in each transaction, not more than 50% transferred, and nobody got more than 50%. So this wouldn't work if there was only a daughter. right? Because daughter would get 100% to be reassessed. Does this work, right? Arguably, it should avoid reassessment. So should, and there's an asterisk on that, because when an LLC is not the original owner, so there's two kinds of LLC ownership where the property was reassessed when it went into the LLC. You're the original owner. This would work. If you're not the original owner, it's different. So long as no more than 50% changes hands and control does not change hands, there's no reassessment. But this is one of those it depends moments that could trigger a property tax reassessment despite everyone's best laid plans, including the lawyer. And let's look at a breakdown of how the step transaction doctrine could apply under this scenario, along with some dry wit and cautious advice. So step transaction doctrine is the grim reaper of LLC planning. Okay, this is literally the death, right? We're trying to avoid reassessment. If reassessment is death, because death results in a reassessment, but we don't want that, right? But if that kills our strategy, these rules, they seem straightforward, and they're straightforward until they're not. The step transaction doctrine says essentially if it walks, talks, and smells like one big plan, even if it's done in stages, we're going to treat it as one big plan. So how might this four-step maneuver raise red flags? So just to recap, husband and wife transfer the property to Marin LLC. There's no reassessment as long as there's a proportional interest transfer, and that's under Revenue and Taxation Code Section 62A2. After the husband's death, the wife and the son and the daughter pull the rental out of the property, and they take the title as 50, 25, 25. Then they form Raman LLC. They recontribute the property, or they contribute the property, the rental. Now it's owned by Raman LLC, 50, 25, 25. And then mom dies, and her 50% goes to the two kids, 25, 25, so that each child now has 50%. So the county might cry step transaction. This is not good. When somebody says step transaction, we're not talking like the Texas two-step dance. This is not a good thing. This is a bad thing. It's good if you're the county. It's bad if you're a taxpayer, okay? The step transaction can apply when there is a pre-arranged plan. Now, the reason I chose death instead of lifetime gifts is I suppose death is inevitable. I'm not sure death is planned. So that might help, but it might not. Let's see. If the removal from Marin LLC to the transfer as tenancy to the tenancy and common ownership, this is after dad dies, and then creation of the Raman LLC, those two steps, if they occur in a tight timeline, and this is under like 2 to 3 years, an assessor might say, hey, these weren't independent business decisions. This was clearly designed to transfer control to the kids. We look at the end result test. If the inevitable foreseeable result was that son and daughter would end up with 100% ownership and control, the county may argue this was in fact the true intent all along, regardless of how it was sliced and diced. So, the Ocean Avenue case involved kids. I think it might have involved grandkids. So there was a mixture. It was two spouses and some kids and some other stuff going on in there. And I think that helped their case. Binding commitment test. This is another test. Were there any arrangements, even informal ones, nod and a wink and or a memo or some understanding made before the first domino fell? This is like before the husband died. And that's gold for assessors. So if they see that, they're going to say, wow, we're going to hit the reassessment button and nice try. You and your lawyers, nice try. Interdependence test. Could each step have happened independently? If not, the chain's likely seen as one integrated transaction. So these are little tests. And then the key, I really think the key risk point here is removal from Marin LLC to the individual names. That's probably the most critical risky maneuver. I think it's pretty suspect because what is the reason to pull a property out of an LLC, which, it's protected under proportional interest exception, only to put it back into a new LLC? Like, what's the reason you would take a property out of an LLC and put it into a new LLC with the same ownership percentages? I think that's really risky. I think that's problematic. From the assessor's point of view, this could be the equivalent of saying, hey, look over here while I pull a rabbit out of a hat. This removal and recontribution may look like form over substance, especially if it sets up an eventual 100% transfer to the kids. So how do you defend against reassessment? Spacing and intent. You can't have that intent. It's got to be spaced out over time. Spreading the transactions out over time with clearly documented independent business justifications is, I think, what you're going to need as a taxpayer. And if you don't have that, you got a tough row to hoe on that one. Valuation and management roles show that wife had true control, management power, and income benefits until the death, and that helps undermine the change in control arguments. This is really, expert legal counsel is required. This is absolutely not a do-it-yourself if you're an individual or for novice lawyers. And I would say if you talk to a lawyer and they say, yeah, this is no problem, we do this all the time, there's no problem, that's a red flag because there are problems. These do come up, and these are very difficult. These are very difficult cases with the assessor, and they're not just rolling over and giving up easy. So I would just a word of caution there. Separate legal counsel. So some firewalls, some things to consider: separate legal counsel for the parties, formal appraisals, internal minutes, reasoned business purpose. You needed a new LLC for better banking, lender requirements, or liability shielding. That stuff goes a long way. That just having it from one, certainly taking it out of Marin LLC and putting it back into Marin LLC. Yeah, that's really tough. And then if there's a change in control. If there's a change in control, you do file BOE 100, BOE-100. That does result in a reassessment. So that's something to be mindful of. The bottom line, this is a risky, complex, and above all, a costly strategy. Reassessment will occur if the assessor applies a step transaction doctrine. This may involve an appeal of a reassessment, and this likely will invite a smell test, okay? And this attracts the county assessor's attention, particularly the recontribution to the new LLC. That's really where we see the problems. I think with savvy lawyering, this might be survivable, might. Now, this is a costly solution, not an expensive solution, because it may be worth it if you have $1 million building that is going to get reassessed at 20 million. If you've got a rental that's 200,000 that's going to get reassessed at 800,000, I'm not seeing, I'm the costs associated with the fees that are involved, I think outweigh the benefit, quite frankly. The other thing that you get is an adjusted cost basis, so don't forget that. So if somebody dies and you inherit property, if that's included in the decedent's gross estate, meaning if it's included in their a living trust, not a bypass, a B trust or a bypass trust or something like that, you do get an adjusted cost basis, which means you can redepreciate the property. Property taxes on investment properties are tax deductible. You pick up more basis, which means you have more depreciation, which means if you have a big reassessment, you may end up after tax not materially different than the parent. Okay. So I think this requires an economic analysis. This is working closely with the three-legged stool we talk about, the A team, the CPA, financial advisor, attorney, and figuring out, does it even make sense to hold this property after mom and dad die? And if so, should you think about avoiding reassessment or not? These are very complex decisions to make. But again, I think if a property is, if you're looking at less than a $20,000 reassessment, I'm not seeing the benefit, just the cost benefit analysis. Death LLCs in Prop 13 and caution. Again, this is the question 27 from the letter to assessor. Does the step transaction doctrine apply to transfers between parents and children? It used to be that it didn't, but since they have repealed the parent to child reassessment exclusion, it looks like it is applying now. Common Prop 19 mistakes. Improperly buying out a sibling after death. We mentioned this earlier. If mom and dad die and you're administering the trust and you want to buy out a sibling, you have to do that at the trust administration level or the probate level. You got to do that. Buying property, then putting it into an LLC. You are not original owner status. I would say if you're ultimately going to have property in an LLC, buy it with the LLC. Thinking a trust automatically protects you from reassessment. It does not. In fact, the assessor's office ignores trusts. They take the trust, they look at who the beneficiaries are, and they ignore everything else, okay? Relying on a CPA or realtor for legal advice on this, not a good idea. I guess it depends on the CPA or realtor, but this is, most estate planning attorneys don't understand this. I mean, I have to tell you, I know because I talk to them, and they say, Jim, I don't understand this stuff. Not coordinating legal, tax, and title strategy. Again, this is ignoring your basis adjustment. So if you get an adjusted cost basis at death and you have more depreciation and you're property taxes are deductible, you need to run the economic modeling to see if you may be better off even after the property's reassessed if you get basis in the property. And with a $14 million estate tax exemption, this is shifting sands. And what we're seeing is we sit down with a lot of people and we look at this and we say, they're really, I don't think you should do anything, right? Keep your parents' trust in place, let those properties get reassessed, and and deal with it that way. You may also want them in an LLC before the parents die, because when that property is reassessed in the LLC, that LLC then gains original owner status, right? So that protects it from future generations. Waiting too long to file forms, since they need to be filed within 1 year of the transfer and death to maintain the property's existing tax base. So if you late file the parent-to-child reassessment exclusion, yes, you'll get it, but you're going to pay higher taxes in the interim. So get those things filed. Even though the deadline is 3 years, if you go past that 1 year, you're going to be subject to increased taxes. So key takeaways from today's materials: Prop 13 can be a valuable property right worth protecting. You need to determine your goals. You need to determine your family's goals, and you can't go back and change the beginning, but you can start where you are and change the ending. And really, we're nearing the ending. So it's a very appropriate quote. This is not easy stuff. This is not a do-it-yourself project. This is not for a novice attorney. This is not for a regular lawyer. It's for a weird lawyer. No, I'm kidding. It's for a lawyer who is expert in this area. We have lots of lawyers in our firm who are experts in this area. You need an expert, savvy lawyer to walk you through this. Use of multiple LLCs is risky and expensive, but may work, okay? But don't fool yourself. There's no easy way. There's no paper you fill out. You can't just come to any law firm or our law firm and say, how much is it for this piece of paper so I don't get reassessed? It does not work that way, okay? It's very expensive. It is not too late to take action. And that brings us to the end of our materials. We have offices in Northern and Southern California. And if you're watching this on YouTube, please subscribe to our YouTube channel. And next, we have the little-known 95% tax on inherited IRAs and how to avoid it. Jim, you may say, 95% tax? This sounds like a communist country. Well, California's income tax is over 50%, state and federal, plus net investment income tax. And then you heap on 40% death tax. And if you don't check all the boxes and do all the right stuff after somebody dies, you end up paying 95% tax. But we're going to kind of unpack that and how to avoid it. So kind of scary, 95% tax on IRAs. We will now open it up for questions. If you're watching this on YouTube, you're going to miss the questions. So I encourage you to sign up for the next webinar. You can go to our website, CunninghamLegal.com, and sign up for our next webinar. I have a whole bunch of questions I'm about to answer right now that we do not post on our YouTube page. So if you want this great content, you're going to need to come to a webinar. Thanks for watching, and just keep watching. Another webinar is going to roll right after this one.